and welcome to this Monetary Policy Special. The Reserve Bank and its Monetary Policy Committee have just presented a monetary policy which stands out for its optimism on growth. The Reserve Bank has raised growth forecasts actually across the board. Full year current FY24 GDP forecast has been up from 6.5% to 7%, highest on the street, and quarter-wise as well. Q3 has been up from 6 to 6.5%, Q4 from 5.7 to 6%. In fact, next year, Q1 of next year also up from earlier 6.6 to now 6.7%. The forecast for Q2 and Q3 next year are new, but just look at the Q2 forecast at 6.5%. Remember, it comes over a 7.6% Q2 this year. So that is clearly indicating a super bullish Reserve Bank. In fact, the numbers are not telling the whole story. Why don't you listen to the governor and the deputy governor on growth?
In the first 7 months, from April to October, 36.7% growth in capital expenditure. Secondly, private capex is also showing signs of revival, particularly in sectors like petroleum, steel, cement, and chemicals.
If you just sort of put that actual number and the projections we made in the last policy together, you'll come with number close to 7 or at 7.
6.86.
6.8, so 6.9. Thank you. But if you look at October-November data, the high frequency data which we use for our nowcasts, they are all very robust right now. So if you just take October-November data, you'll exceed 7. So at the current time, 7 is like a conservative estimate.
You got that? You got that? Dr. Patra, normally conservative central banker, 7% is conservative, he says, for this year. But on inflation forecast, nothing has been changed. The current year forecast retained at 5.4% CPI, and Q1 next year also, they told us 5.2 earlier, and they have retained it, as they said in the October policy, at 5.2%. What's new are the 4% forecast for next year's Q2. Q2 next year, they expect CPI to be 4%, Q3 at 4.75%. So now some economists are therefore expecting a rate cut in Q2 next year because, you know, CPI is going towards 4%. Now, Reserve Bank is worried about food, but it is almost triumphant that core inflation has come down because of their monetary policy. For me, the surprise here is that the Reserve Bank is not that much worried that higher growth is not leading to higher inflation. That surprises me a bit, but we'll ask our experts. Finally, Reserve Bank has emphatically reiterated that bringing down inflation is its top priority. Let me quickly take you through the stance as well. Here, the surprise is there is no surprise of any further tightening of liquidity, that is. The stance is ditto as it was in October, that is removal of accommodation. OMO, that is open market operation of sale of bonds, also remains a weapon, the governor said, and the governor also said that it will be wrong to assume any loosening is round the corner, so as tight as it was in October. Now, besides the policy itself, monetary policy, the Reserve Bank announced some very important infrastructure steps. It is setting up a cloud facility for the financial sector, for smaller entities. It's also setting up a repository for fintechs. Now, all this looks extremely ahead of the curve on digital banking on the part of the central bank. We will discuss all this. Let me introduce my elite panel to you. Dinesh Khara, Chairman, State Bank of India, is with us. Also, Samiran Chakraborty, Chief India Economist at Citi. Mridul Saggar, Chief Economist he teaches at IIM Kozhikode, and he was formerly at the Reserve Bank Monetary Policy Committee. Also with us is B. Prasanna, who is the head of Global Markets Group at ICICI Bank. Gentlemen, thank you very much for joining me. Mr. Khara, I do have a lot of questions for you, but what is bugging me is this growth number. So Mridul, directly that to you. I mean, this is a huge growth revision, 7%, and yet, I mean, normally one would think steaming growth will lead to some inflation. No change in inflation. This doesn't surprise you?
Bit of a surprise. The growth has definitely surprised on the up. If you see what happened in Q1 and Q2 of this fiscal, the numbers at 7.8, 7.6 are very high. We know there is a methodological issue regarding single deflation, which is also imparting an upward bias. But notwithstanding that, the growth is genuinely on a good pace. So monetary policy can obviously breathe easy in not prematurely easing the policy. So that leeway has really come about. And the only surprise which could occur in these calculations, to my mind, could be the Q4 of fiscal 24. That is the number which will come on a base of a 13.1% growth last year. And if by any chance the growth falls below 5.5%, that is where some rethink could occur. Otherwise, there is a case for holding rates higher for longer, allowing disinflation to work and bring it back to the target.
Okay. Okay. Well, I'm still puzzled about the growth numbers in several other ways. And let me get the chairman in on that. Mr. Khara, when you look at the bank disaggregated numbers, whether it comes from the Reserve Bank or individual banks, there's hardly any, lending to the corporate sector because they are not asking. So, I mean, this kind of a fiery growth forecast revised higher, is it borne out by the capex cycle as you see it from your end?
Well, as far as supporting the capex cycle is concerned, some of the corporates are also depending upon their own cash accruals for the time being. And there are some data which is available which shows that the profitability numbers of the corporates are better than that the growth of the GDP number is. So that itself is a very big statement. So that is a very clear reflection that since they have much better profitability, internal cash accruals. So normally it so happens that corporates first of all resort to the internal accruals and then only they move on to borrowing mode. So though we have got a situation where we are sanctioning the limits, but of course there's always a lag between the sanction and the availment. That's a reality. But very often we have seen that if at all corporates have their own funds available, they first utilize that. That's the kind of a situation.
Samiran, you I think are at 6.7, but that's a good 30 basis points higher than your revised forecast that we are getting from the Reserve Bank. You're comfortable with this kind of an upward revision?
So Latha, I think it's quite obvious that the economy has shown significantly more resilience than what analysts would have predicted 6-9 months back. And this is not just about India. Globally, most of the economies have done much better than anticipated. So in some sense, the negative global growth shock that people had factored in the beginning of the year on Indian economy, that has not played out. And some forecast revision is definitely warranted. And I think Mridul was highlighting this point that it's the fourth quarter FY24 where we have maximum uncertainty because there is a significant base effect in that quarter. So to some extent, the RBI forecast revision is a mark-to-market revision. All of us mostly has increased our forecast by about 50 basis points. Since RBI was at 6.5, it is quite obvious that their number is now 7% with that 50 basis point revision. But I think the bigger picture is that what happens after FY24, if our house views are correct and US, Europe go into recession in 2024, then to what extent that starts impacting India's growth, particularly the formal sector's growth, which, by the way, is the one which is driving most of these GDP numbers now. We, as you know, that the informal sector is not captured in the first advance estimate of GDP. So as we move into FY25, if the formal sector is relatively more impacted by the global growth slowdown, then we could see some moderation in growth coming next year.
Okay. Yeah, fair point. If US can grow at 5.2%, then why should we not be revised higher to 7% and next year 6.5%? Yeah, but the whole point is whether the US will continue at that pace. Point taken. A word on how bond markets are going to move. So, Prasanna, to me it looked like cut paste from October in terms of the policy. Do you see at all the call rate coming down towards 6.5? Anything in what the governor said indicating a softness or indicating any change at all? How will rates pan out from here on?
No, in fact, Latha, I would argue that it was not a cut paste to the extent that there was no hawkish surprise that happened in both the previous policies, whether it was ICRR or it was the talk about OMOs. So definitely from that perspective, it was something, a very uneventful policy, I would say. But in terms of how the bond markets have taken it, initially it took it kind of without much change, but later on, when there was a tail in the auction subscription, yields went up a little. But beyond all that, I think the clear message that the Reserve Bank seems to be sending out is that it's too early for us to even think about a change in stance or change in any kind of a rate easing stance. And from that perspective, I do think, and then there was this admission that liquidity was tighter in the last 2 months, and that is also one of the reasons that they didn't do OMO. Having said all of that, I think going forward, liquidity is going to be tight till end of December. We are going to see a lot of government balances getting built up over the next 15-30 days. And then we would see a potential liquidity inflow into the system from government spending in the fourth quarter to the extent of even maybe 2.5 lakh crores. And if that were to happen, it's quite possible that by the end of this financial year, you would see liquidity, coming back into the system a little bit. But either which way you look at it, it looks like even beyond all of this, RBI is clearly engineered a stealth hike, if you can call it that, to bring the interbank rate to something like 680, 685. And unless they start providing funds through their repo rate, the interbank fixing is not going to come down. But they don't seem to be in a mood to do that as yet. So I would say that the fixing continues at this level for some more time. And the first level of bond bullishness or dovishness doesn't need a repo rate cut by RBI. It only needs this liquidity to RBI to change its stance to allow the interbank rates to come back to around 6.5. But that is a discussion for the future, Latha. With this kind of a growth number, I don't think they, in their mind, though they are not upping their inflation forecast explicitly, I'm sure they are aware of the kind of risks that this kind of a growth number has on core inflation. And with food inflation also going to be on the higher side over the next 2 months, I'm sure they have it in their mind, and that's one of the reasons why they are, keeping it tight.
Yeah, if I put myself in those shoes, very large shoes, I would think that I would have these fears. So we'll have to try and prod the governor more when we get time. But I think the big announcements which did not get enough media space or banking space, expert space, is this developmental products that Reserve Bank has announced, a repository for fintechs. We didn't discuss that enough. As well, rules for web aggregators and this cloud facility for the financial sector. It looks like the Reserve Bank is way ahead of its time in ensuring digital banking and digital financial sector. Those questions to Mr. Khara and of course many others to our experts in a minute after this break.